everyone, and welcome to the Market Outlook for 2021. And this is David Acomato, Chief Investment Officer of Thalassa Capital and Professor of Finance at Pepperdine Grazia Dio School of Business. I'm here with two great colleagues of mine, Dr. Clemens Kaunatsky, who's the Chair of the Department of Accounting, Finance, and Real Estate at Pepperdine Grazia Dio, and Chris Manfrey, who's also a professor of finance, in fact, Dr. Chris Manfrey, sorry, professor of finance at the Pepperdine Grazia Dio. Two esteemed colleagues and two astute observers of markets. So hopefully we're going to share some interesting information on what is the end of a very difficult and a little bit crazy year. So let's start with Clemens. Clemens, what's your outlook for 2021? Should we expect a little bit more of this craziness, or things are supposed to die down a little bit?
Well, good question. Thanks for first of all for having me here and having Chris on this podcast or video cast, if you will. What to expect? I remember we had a conversation about exactly a year ago when we looked at the markets going into 2020. And we said, earnings on the S&P were going to be a little lower than the 165 that we looked at. And we were somewhere in the range of 130, 135 in terms of earnings for the S&P. And then COVID happened and a crash in March happened. And we've seen one of the most astounding rallies I've ever seen, both on the crashes, the fastest crash ever I've seen, and the ensuing rally following then. So I'm a bit dumbfounded trying to make a coherent forecast for the coming year. If nothing else, surprises are in store. I mean, we just talked about this earlier, the news out of England that there's a new strain on the virus, shutting down pretty much a lot of the traffic in Europe. That's not happening here yet, but obviously the virus does not know borders. The virus doesn't know calendar years. So, to say here that 2021 will be different from 2020 is a bit of a stretch. Then again, we have new allocations of capital. There's a whole bunch of money that needs to be invested. With what we've seen, in terms of the Fed and the massive stimulus that we've seen, I guess we're all forced to continue to do what we've done this year, hold up our nose and buy tech or something that will do well no matter what, and I think that's for a while, that's at least going to be the story in 2021, because vaccines are out there now, but it's going to be a while until that is actually distributed. And so, my sense is that we're going to have another year that's going to be surprising. There may be some room for rotations because there's so much pent-up demand now. And if anything, as a traditional investor, would say, we've seen this massive rally in tech. The NASDAQ is up 40 some percent this year. And so if we think that things are going slowly back to normal, where people can actually go out and spend money, then maybe some form of rotation will actually take place.
Right. And Chris, do you agree on this? Is it the time to maybe rotate out of tech and go into cyclicals on the idea that maybe the vaccine will ease things a bit and that pent-up demand will have to be met at some point? And maybe also on the subject of valuations, maybe cyclicals are a much better place to be than tech, which is obviously a little bit pricey for a lot of good reason, I suppose, but it is definitely expensive.
Yes, well, thank you for having me, first of all. In terms of that, yes, I would agree with what Clemens just said. I think that a lot of the expectations are already embedded, already priced in the tech. So I think that some level of rotation would be appropriate at this time. we look at some of, without going too much into the details, but we look at the valuation of some of the stock, of some of these companies, including Zoom. I mean, we're all on Zoom. We're on Zoom right now, but you wonder, I mean, how much more of Zoom can we get? How much?
Especially, sorry to interrupt, but Zoom doesn't make any money, right? It's a great
Exactly.
technology, but not extremely profitable yet.
Exactly. So I think that this particular company's tech companies have already achieved they're probably at their peak. Another thing I noticed that corroborates a little bit what we're saying here is the underpricing on some of the recent IPOs. So if you look at DoorDash, right, it was everywhere a couple of weeks ago, and Airbnb. If you look at the underpricing of those two IPOs, they were in the range roughly, and I don't remember exactly the percentages, but we're talking about a 70%, 60 to 70% under pricing. And breaking the news a little bit here, the last time we saw such level of underpricing for tech IPOs, that was just prior to the dot-com bubble in 2000. So, that's a clear sign in my mind that some of these tech stocks are definitely, at the peak. Again, who knows? There's a lot of uncertainty, as Clemens mentioned, going in 2021. Is the vaccine going to work? Is it not going to work? So I think we'll see a lot of the same going in 2021. But again, we wonder as we dive more into the new year, can these tech stocks really do better than what they have done so far? So I think again, as you mentioned, David, it would probably be appropriate to consider some level of rotation at this point.
Okay, and in terms of so rotation is a good thing. But should we scale down on the equity portion, or should we maybe even increase it? So we get out of tech and we go into cyclicals, we stay at the same weight on equities anyhow, or as we rotate, do we increase equities? Because at the end of the day, yeah, we can make the case that tech is very expensive, but bonds, I would say, they're probably even more expensive. So as Clemens was saying, should we hold our nose and actually increase equity exposure, just maybe move from one sector to another? What's your take, Clemens?
Good question. Again, I was just looking at a chart earlier, and it occurred to me that there was a switch between value and growth at the end of 2000s, just like Chris was saying. And we're kind of at that same level again in terms of overpricing or underpricing value versus growth. I usually do a very simple, super simple kind of barometer for me. I look at growth, NASDAQ 100, right? So NASDAQ 100 is up 45% this year. Berkshire Hathaway is up barely breaking even, if that, for this year. So the NASDAQ is up 45 versus Berkshire Hathaway, which is, to me, is the proxy for value investing. And if you look at the whole decade, the NASDAQ 100 is up 650%. Berkshire Hathaway is up 240%, right? So I think there's perhaps some room to justify that switch. And then in terms of valuation, if you look at the longer time horizon and look at Shiller's CAPE ratio, that's now at a level that is reminiscent of the 1920s, 1929 crash.
True, but even though let me pick up on that, because if you reverse the cyclically adjusted PE ratio, you get the long-term equity yield, which is in fact extremely low because the Shiller ratio is high, obviously, so the reverse would be really low. So I think it's only about 3%. However, which is historically low. However, when you compare it to when you actually calculate the spread over the real interest rate, so nominal rates minus the inflation rate, actually that spread is kind of in line with history. So when you, again, I suppose what I'm trying to say is in absolute terms, which seems to be extremely expensive across the board, but on a relative basis, which was the beginning of my question, against bonds, especially government bonds, then we're not really that expensive. is there something there that we as investors should be aware of?
Yeah, perhaps, like I said, maybe a justification to switch from growth to value, at least to some extent. And as Chris was saying, Zoom already has all the clients they need in the US. Netflix, how much more Netflix can you watch? They're not going to make more money from all of us watching, Netflix all day long. And there's a few examples like that. Um, and again, we're speculating here, but if there's some form of normality, people will be spending, will be going outside, and there's going to be some form of pent-up demand recovery that we'll experience, and that again justifies perhaps a bit more switching from the purely kind of virtual world that we've all lived in for almost a year now to something, you want to go out, I want to breathe some air, I want to have some actual life experience, touch something and have a tangible sort of experience, and the money spending that comes with it, whether it's travel, whether it's going out to restaurants, whether it's buying physical things more so than virtual. I think that can help that rotational argument to be made.
And that's a good point, especially on the pent-up demand for traveling. Chris, do you think that there are opportunities in that sector, traveling, energy, maybe cars? Are we all waiting to just go out there and start moving around the planet one more time? Or do you think that we have now permanently changed the way that we experience our life and we're just going to sort of travel less, move less? What's your take?
Yes, that's a great point. Just to touch briefly upon the idea of the PE ratio, I find it to be extremely high personally, and then I'll tackle your question. We're at 37 times, PE ratio is 37, the Schiller is 33, 34. And if we look at the Schiller PE ratio is the second highest historically after what we experienced in 2008. If you look at actually the regular PE ratio, it is the third highest, okay, after the dot-com bubble and basically the subprime crisis of 2008. So these levels are a little bit concerning. Now, going back to your initial question about traveling, I think personally, I don't think we're going to change the way we operate. I know that every time we might think that, oh yeah, no, now it's going to be different. People are not going to want to travel. I think there is going to be actually pent-up demand for that type of experience tremendously in that sense. And so I think that we will go back to the old way of doing things, but not yet. So I'm still very tentative about saying that 2021 will actually see a reverse in this tendency. So I would still be a little bit cautious, so to speak, going in 2021. It might take a while for some of those stocks to recoup, but yes, I think that eventually we'll go back to the old ways of doing things and enjoying our lives and traveling, etc.
And on this positive comment, we're going to take a quick break and then we'll come back for our second segment.